Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Calming nerves, Japanese authorities step in to ease bond market gyrations, setting off a global rally. Pedal to the metal, futures rally as the EU agrees to fast-track trade negotiations after President Trump extends the deadline. And BYD beats Tesla. The Chinese EV maker sells more cars in Europe than its American rival for the first time ever. It is a rally underway after your long weekend. Hopefully you got your rest in, because no respite for the weary. We're up 1.4% for your S&P. NASDAQ 1 futures up 1.6%. We are back around to a round trip as to where we were before Trump threatened the EU with the 50% tariff. Is this a market that's dealing with some fear fatigue? Of course, President Trump backed off of that, but a rally underway. A rally also in the bond market. This is due to something different. Japanese authorities, will get into this in just a moment, talking about trimming back their issuance. So if you look at what Japanese yields are doing, they're down 17 basis points. That's the biggest move since the April 2nd Liberation Day, and it's having ramifications across global bonds. German yields are lower this morning too. Your U.S. 10-year yield down about 5 basis points. That's your overall markets this morning. Let's get some stocks to watch with. That is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So we're starting off with a bit of M&A in the data world. In software, we're seeing news that Salesforce looking to do a takeover potentially of Informatica. That could be worth up to $7 billion, and we are seeing Informatica rising around 10% at the moment. Salesforce edging up in the pre-market as well today. Then we've got DJT, the social media company owned by Donald Trump. Of course, that one gaining as the company said to be looking to be doing a share placing aimed at buying a load of cryptocurrencies, potentially around $3 billion worth, according to our reporting. Trump Media and Technology gaining around 12% in the pre-market this morning. And then finally, US Steel up once again. This is a second day of gains after Trump announced the partnership with the company and Nippon. It's kind of unclear whether this will be a takeover or a bit of an investment, but we are seeing US Steel gaining around 2%. Jefferies is cutting the rating on that one today, thinking that the gains might be overdone. As usual, these are all available on our fantastic Before the Bell opening wrap on the terminal this morning, Danny.
Who would have thought we'd finally get a conclusion to this deal? Joe, thank you so much for covering that for us. We'll catch up with you later in the hour. That is Bloomberg's Joe Easton. Also in this hour, in just moments, Juckes of Societe Generale will be joining us. Later, we'll also catch up with Rob Casey of Signum Global Advisors as EU negotiations continue on. Now, I mentioned this. Japanese government bond yields are dropping as speculations mount that the finance ministry could tweak its debt issuance. Joining us now is Bloomberg's Rachel Evans. Rachel, what has been the reporting on Japanese authorities this morning?
Yeah, so we've been hearing that we've had a survey going out to Japanese bond traders and bond investors about issuance and about the type of supply that is working for them and the type of supply that's not working for them. Obviously, the context to this is that we've seen a sell-off in Japanese bonds in recent weeks. We saw some very poor auctions coming through there. So there's a lot of angst about whether there's really a mismatch in the supply and demand within Japan's bond market at the moment. As the Bank of Japan kind of pulls back on its bond buying program, are there enough people to kind of step in and take up the slack? So this questionnaire kind of comes at a time when those questions are all floating around and really seeks to kind of get input from the bond market participants as to sort of how they feel about recent volatility, how they feel about recent supply. And people are really viewing it as kind of like the beginnings of maybe a conversation about possibly pulling back on supply, which is why we're kind of seeing yields falling so significantly today.
Right, and it comes only just about this time last week when we had that horrible 20-year auction in Japan that seemed to kickstart some of the losses in the bond market. Rachel, it's not just the Ministry of Finance we've heard rumblings from. It's the Bank of Japan as well that initially led to gains in the yen. Could hikes be coming for the Bank of Japan?
Yes, but very, very slowly, I think, is the answer to that. We've been seeing that the Bank of Japan really moving very carefully as it seeks to raise rates. We're not seeing kind of, necessarily any sense that we're going to see the Bank of Japan accelerate. But, we saw Ueda come out again today and talk about sort of the slow progress towards inflation. And that does suggest that we are going to see that kind of path of hikes continue in coming months. At the moment, it seems unlikely that we'll see anything sort of prior to kind of September or towards the back end of the year. But that's certainly kind of what prompted people to start kind of thinking about the yen again more closely from that perspective.
Rachel, thank you so much for joining us this morning. That is Bloomberg's Rachel Evans. Joining us now, I'm pleased to say, is Kit Juckes, Chief FX Strategist at SocGen. And Kit, quickly, the reporting from the MOF quickly taking the wind out of the yen's sails when it comes to possibly pulling back on bond auction issuance. But is this just the beginning of necessary action from policymakers with gyrations that, let's be honest, are also coming out of the U.S. with the issuance likely coming from there?
Yeah, look, I think that if you have a perception as a debt issuer that the long end of the curve is not popular and the depth of demand isn't there, why waste money by borrowing expensive money? If there's a structural issue of we're nervous about inflation and things like that, if you're a central bank, you tell your debt office, back us, we'll have inflation under control over the medium term, and these yields, these rates we have now won't last forever. And you pull away. And then you have structural things like we have, for example, in the UK, where the pension industry has changed and the demand's not the same. So it just makes sense to me not to keep on trying to sell bonds that people don't want and to focus selling parts of the maturity spectrum that actually there are buyers for, and then it calms it down.
But when it comes to the driver of this market, Kit, how much over the past week do you see coming from places like Japan, of people wanting to put their money in other assets in other markets versus what's happening in the U.S.? Is it the U.S. that's in the driving seat right now?
The U.S. drives the market in the sense that it's driving the economic piece. The tariff policies are driving the global economy and sentiment about it. But we're in a sort of a dead zone where there are not imports arriving at U.S. ports on the West Coast that are going to have to pay high tariffs yet, and that are going to go into consumers, and we're going to see the reaction. We're not seeing that. So we're trying to work out where we are without much useful information. And in the meantime, we're watching markets. What we find is they're hyper correlated. So if one long end sells off, you can't work out exactly which bit started it, but they all do. And we try to work out what that means in turn. So, yeah, what we found out is that the global markets are still very joined up. That's not a big surprise. What we're trying to do at the moment is, for example, in the foreign exchange market, is figure out whether we get another move soon or whether we're just going to have to wait for economic news over the summer that tells us where we are. And you get a sense a bit, dollar yen, 140 something, euro dollar in a range, very choppy, very reactive, but not necessarily going anywhere.
Kit, we might be waiting for some time. Some Fed policymakers have said it's something like a timeline of September when the data will finally start to make sense. What does that mean in terms of the dollar, where it goes? Because one could argue that the dollar isn't weakening more because there has been some strength in the economic data. How much of that is a pull forward and will result in real weakness, maybe once the data catches up?
Well, again, the dumb answer is it'll depend on the data. But yes, right now, everybody was very quick to revise down their U.S. growth forecasts. So that's done, and now they're creeping higher, and the dollar looks, it looks a little bit oversold on the now data. But we don't know, and I think that's going to be the big test. If the U.S. economy breezes through the arrival of more expensive imports and just powers on, then the dollar's too cheap. That just seems unlikely, frankly. But we at the moment we're just kind of figured out. I do think in that sense, though, I think it means euro dollar and dollar yen in particular are going to be in ranges. Some of the other currencies we might have different stories for.
We also have a positive fiscal impulse, too, coming from the American budget coming out. Kate, usually you get more borrowing, more spending, wider deficits. That money shows up in corporate profits, higher stock markets, and often that means foreign money flows into the U.S. and a stronger dollar. Do you expect that to still be the case this time with the budget going through Washington?
As it gets through, we've seen, obviously, the downgrade didn't really matter at all, but there is concern about the direction of U.S. fiscal policy in markets. That's a source of some nervousness. And if that concern translates into not just higher, really long-dated bonds, but higher bonds along the curve, then it's going to be problematic. But in the normal course of events, it means that, for the sake of argument, five-year yields are higher in the US. They have a different fiscal monetary policy than others. I mean, the same is happening everywhere else, and that's part of the challenge. The Europeans are easing fiscal policy. If the Japanese adopt fiscal policy that's easier and the Chinese do, then the big danger is that we've got a shortage of global savings relative to all this debt arriving, and then I'm not sure I would want to be the biggest borrower in the world.
Yeah, fair enough. I mean, you have to put that money somewhere, though, Kit. I mean, do you buy this narrative that there could be a foreign buyer strike in the bond market or not so if, again, most global bond markets are dealing with a similar issue?
No, I just think that price discovery, if you like, is going to take yields, real yields will be higher. The term premium will build itself back in. I think my concern is back in the foreign exchange market where you've got to start out with, at the beginning of this year, foreign investors had $62 trillion worth of U.S. assets. Do they want to grow that number is the question I don't know the answer to. But it does seem to me that that's what everyone's now aware of. We are all very long U.S. assets overall.
I guess the question, though, Kit, is it just a readjustment of that? Or is it a new framework we're dealing with? George Saravalis, for example, over at Deutsche Bank, has started to talk about a dollar frown, that at one point, at one side, you have too much fiscal easing. The other side, you have too much fiscal tightening, and both result in a weaker dollar. Is it a new framework, or is it just a readjustment of too much exposure to U.S. assets?
I think it's just a bit of a readjustment, a bit of kind of, looking in the mirror and am I comfortable with the amount of dollar assets that I have? But I think more than anything else, it's uncertainty. This is politically driven in the sense that these are big political changes and the market is unsure about where it goes and investors are unsure. And at that point, the dollar is vulnerable just from people saying, hang on, until I know how all this tariff stuff plays out for the U.S. economy, for inflation, for growth, for the global economy, I think I need a defensive positioning. And if I'm a German investor, why wouldn't I bring some money home into the German bond market, which is offering much higher yields than it has been for years?
Kit, truly one of the best. Thank you so much for joining us this morning. That is SocGen's Kit Juckes. Let's now get some other top stories that are trending on the terminal this morning. HSBC has laid off over 24 analysts in recent days. That includes their global head of fixed income. Bloomberg sources say most of the cuts were in Europe. The move is the latest in a process of restructuring and streamlining that began when the CEO took the helm last September. Dutch pension fund PME is issuing a blanket warning to U.S. money managers: don't cave into pressure from the Trump administration. The $65 billion fund is concerned that the president's handling of issues like climate change and demolishing the judiciary aren't being condemned by firms. PME is the latest European pension fund to review or rescind its mandates with firms like BlackRock and State Street. European auto sales dipped 0.3% last month, led by a decline in demand for gasoline and diesel cars. Global trade uncertainty has also been prompting consumers to hold off on larger purchases. Sales in EVs rose 28% last month, but still make up a smaller share of the market that some analysts had anticipated. Coming up, trade talks accelerate. The EU is ready to negotiate with the U.S. as President Trump delays the 50% tariff deadline. We'll discuss that next, coming up on your Bloomberg Brief.
Very nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
President Trump has agreed to extend the EU tariff deadline after speaking with European Commission President Ursula von der Leyen over the weekend. Now the bloc is prepared to accelerate talks. The EU spokesperson responded to the move saying, quote, there is now a new impetus for the negotiations. They agreed both to fast track the trade negotiations and to stay in close contact. Joining us now is Bloomberg's Brendan Murray. Brendan, what does that even mean, to fast track negotiations?
Well, it means that they're going to get on track and they're going to start talking about specific issues. This time last week, these talks were going nowhere. They were exchanging proposals, rejecting each other's ideas for how to get these negotiations going. But we've got now a 6-week sprint to try to do a deal in the world's largest trade and investment relationship. It's going to be a real short amount of time to get a lot of work done. I think we could expect something incremental to get done on some of the key issues like tariffs and non-tariff barriers, the steel and aluminum tariffs that the U.S. is imposing. But there's a whole lot of work to get done. But I think the key word for President Trump was speed. He thought the EU was dragging its feet, and von der Leyen, it seems, was able to communicate the message over the weekend that they're ready to move fast.
Well, trying to do this fast, Brendan, had always been part of a problem, too, though, because it's not just the EU they're talking to. The start of July also comes with the deadline of all the other reciprocal tariffs, not to mention China's pause, too. How's the administration going to get all of that done?
Yeah, I mean, and the EU is a particularly complicated one because all 27 nations of the European Union have to be on board, so there has to be a lot of back and forth internally, Brussels to the other capitals in Europe. And as you suggested, there are negotiations that are even further along with countries like India, South Korea, and Japan. Thailand is in there with its talks going on. So, and then of course China. China's on a separate deadline, a separate 90-day period that ends August 14th. And so we'll see if the Trump administration can juggle all these things and deliver something substantive in the next 6 to 8 weeks.
Well, Brendan, when these negotiations first started, or after Liberation Day, there seemed to be a real willingness from the Trump administration to put on tariffs that not just punish global economies, but punish the U.S. economy, too. Instead, what we've gotten is Trump backtracking or giving pauses for various nations. How does that color negotiations at this moment?
Yeah, you would think that, well, we're starting to see a pattern, basically. He starts out with, the reciprocal tariffs, talks don't go anywhere. Then he takes those tariffs to an extreme level. Those create some momentum for talks. He pulls back, and he sees where they can go from here. I mean, the bottom line is that the world is looking at a 10% universal tariff into the U.S. market, and all these other numbers that are being thrown around, the 50% for Europe, the 145% for China, they're going to look pretty. They're still going to wind up with something on the order of a 10% tariff on U.S. goods. It depends. They'll negotiate the fine print in the next several weeks, but it seems pretty clear that the Trump administration has established that 10% as the floor that's not up for negotiation.
Brendan, thank you so much, as always, for your coverage. That is Bloomberg's Brendan Murray. And I should mention, U.S. futures now back around to the levels that they were at before that threat from President Trump of an EU 50% tariff. We're up 1.5% on your S&P 500 futures, a market that's perhaps more accustomed and now partially assumed that full threats won't materialize from the Trump administration. Coming up, we're going to take a look at what else is making headlines around the world, including the introduction of checked bag fees at Southwest Airlines. We finally have the price on what that will cost you. This is Bloomberg.
A stagflationary shock, if Jamie Dimon is correct, pushes up inflation, pushes down economic activity. But our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode.
The Minneapolis Fed president there, Neil Kashkari, saying something we've heard time and time again from Fed speakers as of late. That is cautiousness and keeping things as are in the face of uncertainty around tariffs. All right, let's get you some front page news and look at what's making headlines. First up, the Wall Street Journal on the front page over there reporting that Southwest Airlines will start charging for checked luggage. This is something we already know, but we finally have the cost for you. The first checked bag will cost flyers $35. A second will face a further $45 fee. Something that had concerned a lot of people, considering they used to not do that. All right, and the New York Times reporting on this, a tragedy in England. Nearly 50 people were injured after an unnamed 53-year-old driver slammed a car into a crowd celebrating Liverpool's championship victory. We wish the best for all of those affected. Next, the Financial Times leads with the EU's plans for a sweeping stress test of non-banks. Regulators are going to look for vulnerabilities in the financial system due to fears over the rapid growth of hedge funds and private equity. All right, a quick check on your markets this morning because we are in the midst of a rally for your S&P 500 futures. Those are up 1.5%. Again, we've come round trip. We're back at the levels that we were before President Trump threatened a 50% euro tariff on the EU, 50% tariffs rather. The Bloomberg Dollar Index, that is higher, and your 10-year yield's down by 4.5%, that move being led by Japan. And the MOF reportedly considering trimming back some of its issuance. Now, coming up, we're going to be catching up with Rob Casey of Signum Global Advisors on his low hopes for a U.S.-EU trade deal after we did indeed get a pause in that. Will we get negotiations with so much to be figured out before early July deadlines? All of that coming up on your Bloomberg Brief. You're watching Bloomberg TV. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Calming nerves, Japanese authorities move to ease bond market gyrations, setting off a global rally. Pedal to the metal, futures rally as the EU agrees to fast-track negotiations after President Trump extends the tariff deadline. And BYD beats Tesla. The Chinese EV maker sells more cars in Europe than its American rival for the first time. Well, another delay. We had a call between Trump and von der Leyen on Sunday. Futures back to where they were before Trump threatened a 50% tariff in the EU. We're down just under 1.5% for your S&P 500 future sessions. Elsewhere, the bond market is also rallying this morning. Authorities in Tokyo biting the bullet, acting to calm the nerves of investors. The reports that the Ministry of Finance is sounding out, trimming its issuance, putting out surveys. That after this point last week, the 20-year auction went so poorly in Japan, so yields down across the board, down 17 basis points for your Japanese 20-year yield, about 5 basis points for your 10-year yield at 4.46 this morning. Those are your overall markets. Let's look at the stocks to watch. Here's Bloomberg's Joe Easton with what's on the move. Good morning, Joe.
Hey, Danny. So we're starting off with a bit of M&A in the data and AI space. We're seeing news that Salesforce could potentially come in and buy Informatica. That could be worth around $6.8 billion, according to latest report. Bear in mind, there was reports around a year ago of a deal coming through, almost double the size of that in terms of the valuation. So some people might potentially not be too pleased about this latest news today. Then we've got Donald Trump's media company in focus as well, looking to potentially do a share placing and raising around $3 billion worth of cash to spend on cryptocurrencies. There is a big event going on over in Vegas, a crypto event. That's the place to be at the moment. But that stock up around 13% in the pre-market. And then finally, Stellantis in the car space. This is gaining, catching up after we all had a day off yesterday. That is on news of Trump delaying that potential 50% tariff, as you were discussing a moment ago there, Danny. So we are seeing Stellantis up around 7%, even surprising me in terms of that move there. Keep an eye on Stellantis and the other automakers this morning, Danny.
Joe, excellent work this morning. That is Bloomberg's Joe Easton. And speaking of that, the U.S. and EU are looking to fast-track trade negotiations after the tariff pause from President Trump. Rob Casey of Signum, though, is not keeping his hopes too high on a potential trade deal, writing, quote, "We remain pessimistic regarding a potential U.S.-EU trade deal as the sticking points remain, in our view, too numerous and too significant to overcome." I'm pleased to say that Rob joins us now. He's senior analyst at Signum Global Advisors. Rob, the market is quite optimistic that we got this pause, so a little bit of different tone there. Why do you see a deal is unlikely?
Well, I think it is good news that we've got the pause over the weekend, right? We actually, my colleagues Andrew Bishop and Nico Fitzroy published a note on Friday morning, feels like a lot longer ago than that, to say that we didn't expect that this 50% to come into place on June 1st, for the most part because it was too big and too fast, right? So we did see it as both a carrot and a stick for Europe to come to the negotiating table. The issue from here is, even though there is, I think optimism around mood music and desire to get to a trade deal, the things that they're negotiating, Donald Trump does not appear willing to budge, and Europe certainly isn't and can't budge in the short term, right? These are things like the carbon border adjustment, things like VAT, right? They are institutional and important and entrenched in the European system. They're not, just things that can be raised or lowered at will.
So then what takes its place? If you can't have any sort of negotiation, if there's not any movement, what does the trade relationship between the U.S. and Europe look like?
Well, I think what the market may be reacting to, in a positive sense today, is not just that the U.S. and EU are going to get to a trade deal in the short term. Again, we think they won't. But rather that President Trump is going to continue to delay, right? And we've seen that throughout the course of his second term. He will make significant threats. And there was an argument, I think, in his first term and into his second that, you take him at his word, right? The threats that he makes are what he's going to follow through on. I think, we've seen since then, certainly since the beginning of his second term, that that's not always the case.
Well, especially on that, if you are to negotiate the whole art of the deal, the idea being that you are willing to shoot the proverbial hostage, in this case being the American economy and markets, if Trump isn't willing to do that, how does it color negotiations from here? How do other nations approach the U.S. with full knowledge that Trump keeps reversing? Well,
I think, frankly, it makes negotiations harder for the Trump administration, right? Because if you're Ursula von der Leyen, if you're South Korea or India, countries and blocs that Trump is really pressuring to get to trade deals, you kind of say to yourself, we're willing to give on X, Y, and Z, but the truth of the matter is we don't believe that Trump is going to follow through on all of his threats. Now, the thing is, we get to early July, and President Trump is going to have to show the American people something, right? He's either going to have to show them deals, or he's going to have to ramp tariffs back up. And so to that extent, I think markets are maybe a little bit too optimistic going into July. If we get to early July, without any of these deals, I think President Trump is going to have to, take some skulls.
To that point, what do you expect early July to look like? Because there are a lot of deals. The only thing we have is an agreement of sorts with the UK. We're still waiting on Japan. The EU, to your point, still looks far off. So what are we likely to get in about a month's time?
I think we're likely to get a resumption of at least some tariffs. And it's because if we get to early July and President Trump has not gotten the deals, the bilateral deals that he wants, he has two choices, right? He can punt further, and I think that really demonstrates to other countries that he doesn't have a whole lot of leverage, or he can bring tariffs back on. And that's not to say that it'll be a brave new world and those tariffs will stick forever, right? But there has to be some stick for countries to come to the table with the U.S., and even for those countries that are already at the table for the U.S. to actually get a deal done, right? If we get into the middle of July, Trump isn't willing to offer many carrots, and if the stick sort of evaporates, then he's not left with a lot of leverage.
So one thing you are more confident on, fair to say, is the big, beautiful bill passing by summertime.
Yes. We now think, for full transparency, we were pretty skeptical that the House would be able to have as much progress as they did, into last week, right? It's now through the House. I think, importantly, it's through the House with a framework that looks pretty good to most senators. Now, the truth of the matter is, in our bicameral system, the Senate certainly sees itself as being superior to the House. They're going to want to put their fingerprints on the bill. They're going to want, the right of authorship is what they say. That being said, I don't think that the changes that we are going to see from the House into the Senate are going to be so significant that essentially the process breaks down, right? I think the Senate will make some tweaks. President Trump will push them to make narrow tweaks, small tweaks. He said he's fine with changes, right? But I think he's only fine with changes that the House can then, repass through and he'll be able to sign by the August recess. July 4th is optimistic. It's an aggressive deadline, but I think certainly by the August recess, Congress will come together, the Senate and the House, of course, not with any Democrats on board, but Republicans will come together and get it done. But
there still seems no impulse to sort of rein in any of the fiscal deficits, any of the fiscal trajectory that we are in. Is there any mechanism to do that, or is this set in stone? Are we on the path we're going on right now?
I think we're on the path we're going on. There are a couple of senators who Ron Johnson in particular, have said, there aren't enough spending cuts, that the fiscal impact of the bill is too negative for them, right? There's probably not a blocking majority in the Senate. There are 2, maybe 3 senators on the Republican side who feel as though this bill doesn't work as it is currently written. If we were going to see more stringent fiscal measures, we would have seen them in the first House bill. And so at this point, I think, we're proceeding forward as is. And there are certainly some concerns by Republicans in Congress. But when President Trump tells them to pass a bill, unlike tariffs, which we've seen he's willing to pause on, he's not really willing to pause when it comes to pressure on Congress. And they generally do what he says.
If we do indeed get this bill passed, which again, all signs pointing towards this, George Service of Deutsche Bank has been writing about this idea that we become locked in, that just because of potential changes in the midterm, because of the difficulty of reconciliation, that what we get now is law basically for the next decade. Do you think that's fair, that we have to worry about this fiscal debt trajectory for the next decade and whatever the outcome of the passage of this bill is?
Yeah, it's a really interesting point and a really interesting question. I wouldn't go so far as to say we are locked in, but I think we have a 2-party system and neither party is willing to take the deficit seriously. So from a legislative perspective, are we locked in? I would say probably not. As we get more polarized, we will have more trifectas, right? Come 2028, it's not out of the question that we'll have Democrats across the board, right? Maybe we have Republicans again, but I think more likely we swing back to Democrats. The issue is, no matter who's in charge, it seems as though the deficit continues to expand. So I think from a kind of socio-political perspective, we are locked in that, the government is doing a lot of spending and not doing a lot of cutting.
Rob, it is so wonderful to have you on. Thank you for coming and joining so early after a long weekend. Rob Casey there of Signum Global Advisors. Let's get you now some other top stories that are trending on the terminal this morning. HSBC has laid off over 24 analysts in recent days. That includes its global head of fixed income. Bloomberg sources say most of the cuts were in Europe. The move is the latest in a process of restructuring and streamlining that began when the CEO, Georges Eldury, took the helm last September. Dutch pension fund PME is issuing a blanket warning to U.S. money managers: don't cave in to pressure from the Trump administration. The $65 billion fund is concerned that the president's handling of issues like climate change and demolishing the judiciary aren't being condemned by firms. PME is the latest European pension fund to review or rescind its mandates from firms like BlackRock and State Street. Now, as we've been discussing, the European Union speeding up trade talks with the U.S. The bloc has 6 weeks before President Trump's threat of a 50% tariff comes into effect. The European Commission plans to focus its new strategy on critical sectors, as well as tariffs and non-tariff barriers. Coming up, global bond yields taking a dip, a rally underway as Japan's finance ministry said to be considering adjustments to its debt issuance. We're going to have more of that next. Stay with us on your Bloomberg Brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. So long end global bonds are rallying this morning after a tough week last week. Bets have been piling up that Japan's finance ministry may be prepared to adjust debt issuance. Bloomberg's Erica Yokoyama joins us now from Tokyo for more. Erica, a very different picture than how things were last week. What's the latest reporting on what the MOF might be considering?
Right. So actually, we had quite a few developments today. And I think the one driver behind the move is, as you said, the report that the Japanese finance ministry sent out a questionnaire to bond market participants, including like primary leaders and bond buyers, about the appropriate issuance volumes. Then that market took it as a sign that the finance ministry might revise its bond issuance plan, especially it raised the speculations that the finance ministry may reduce issuance of super long bonds after the last week is 20 years bond auction saw the weakest demand in over a decade. And the timing also coincidence closely watched 40-year bond auction on Wednesday as well. And, the finance ministry is set to hold a meeting with bond market participants in late June, the outcome the market is closely following. But, like in the meantime, even if the finance ministry cuts the amount of bond supply, it won't probably address the concerns about Japan's finance health. The Japanese finance minister Kato this morning said that, at the moment, rising yields is probably not preventing from stable issuance and sales of JGB. But he also cautions that the higher yields could raise debt servicing cost for Japan and strain the national budget.
I say, Erica, can you speak to the moment of fragility right now for the JGB market when you have a BOJ that does own 50% or thereabouts of the bond market?
Yeah, that's right. And also, like Ueda, the BOJ's Governor Ueda speak today, then he just, so we will have soon the BOJ meeting in mid-June, like where the bank is also going to announce the bond purchase cut plan beyond April 2026. And, depending on the result, that will probably see another turbulence in the market as well. And speaking about the Bank of Japan's policy, and, Ueda today had a speech at the international conference, and in a rare movement, he reiterated the bank's current policy, which means the bank will continue with keep raising interest rates. And, that's highlight the importance of the banks communicating amid the growing uncertainty. And also he also noted the difficulty to measure the inflation trend at the moment, saying that Japan is now undergoing second shock of the second supply shock, especially for food. So that points to some focus on the Friday data on inflation as well.
Erica, really excellent reporting this morning. We appreciate your time with us, or afternoon for you there in Tokyo. That is Bloomberg's Erica Yokoyama. Now, over in Europe, BYD has beat Tesla in sales for the first time. The Chinese EV maker notched an 169% year-over-year surge in registered vehicles in April, while Tesla's halved. Here to break down the latest European data is Bloomberg's chief European correspondent, Oliver Crook. Oliver, how much of this is about BYD's popularity versus Tesla's lack of it?
Yeah, I think it's actually the two. It's like the two elevators are crossing at this sort of very point. One going up at extreme speed, that is BYD, and Tesla going down also at just remarkable speed. So I'll just get through the numbers because this was really the standout from the European car data that we had earlier today. April sales for Tesla year on year that month down 49%, down 50%, almost halved the number of cars that they sold from a year ago. When you look at the year-to-date figure, how many cars they sold year-to-date, that is down also 40%. When you then look at the kind of market share that Tesla was enjoying in Europe, a year ago, it was 1.3% of all of the cars being sold in the European market, not just in EVs, in all of the cars across combustion engines, diesels, hybrids. It was 1.3%. Today, in the month of April, we stand at 0.7%. And as you mentioned, Danny, you can have these one-offs from time to time, but you've seen consistently here in Europe the decline of Tesla sales. There's speculation about how much of that is Elon Musk's affiliation with the Trump administration. Let's also not forget he was very sort of active in some political discourse here in Europe, in Germany, supporting the AfD. That may not be helping him at all. And as you say, BYD, on the other hand, though its Tesla sales were down 50%, up almost 170%. So you see them sort of crossing each other here in the month of April. And we should say also, Danny, BYD faces 17% tariffs in all the cars that they sell here in Europe because they're all produced over in China and sent over here. Tesla is producing many of them here. So it's kind of also a test case, interestingly, in how sort of tariffs affect auto sales across the world.
And maybe something that the EU is not too pleased about if they still have Chinese goods coming into the market, rerouted from the U.S. with more onerous tariffs. But Oliver, the economic backdrop is one where European car sales as a whole fell. Just how difficult of a moment is this for automakers in Europe?
Yeah, Danny, it's maybe not a total shock that you get a sort of people pulling back and not spending on those big ticket items the month that basically a global trade war is launched across the world. And that's exactly what we saw. Remember, Liberation Day was, April 2nd? And this is data from April. So we saw European car sales across Europe down 0.3% for the month of April. What's interestingly, though, is that actually if you strip out the non-EU countries, including the UK saw sales go down by 10%. European sales just in the EU were up 1.3%. And Danny, I know this is a little bit nerdy, but this is what I enjoy looking at when we look at the actual car sales here. When you look at the engine type, what I think is very interesting is you've seen evolution in the month of April. Gas and diesel down 22%. EVs up 28%. And when you look at market share of all of the cars sold in Europe, that is slowly climbing for EVs. It's now almost 20% of all the cars sold in Europe are EVs. So you're seeing that trade sort of flip a little bit, despite the fact that there's been so much economic uncertainty, which you think might favor gas and diesel. Not so in the month of April.
Yeah, maybe you'll get more news like this, though, of BYD cutting prices. That's why you see share prices off this morning, maybe trying to gain market share. Oliver, thank you so much for joining us this morning. Bloomberg's Oliver Crook there. Now, there is one big market event, perhaps the event that everyone will have its eyes on this week. It is after the bell tomorrow. NVIDIA is set to release its earnings. Shares are higher this morning by 2.7% or just thereabout. For more, let's get more with Bloomberg's Charlie Wells. Charlie, what are we expecting tomorrow?
Danny, we are expecting some positive reporting coming out of NVIDIA. So expectations are pretty high going into this much anticipated earnings report. So they are expected to post a strong quarter that ended in April. But what analysts are really looking for as well is that forward guidance. And we're expected to see revenue from NVIDIA's core chip business expand over the next 4 quarters. So that is something that investors are going to welcome if it comes out in a positive way. And of course, this is a barometer stock. This could show us what appetite has been and could be like for AI demand across the industry. It could also bode very well for the broader stock market, which of course we know has recovered significantly from those lows in April. According to BBVA Strategist, there is some $7 trillion parked in cash funds. So a positive report here could help not just NVIDIA, but a lot of these other U.S. stocks that have been on something of a recovery. But still, we could see trade tensions come into play here. We know that NVIDIA has talked about a $5.5 billion write-down based on some of these export controls that the Trump administration has implemented. So positive expectations, but we are waiting for surprises as well.
Yeah, Charlie, it really feels like a lot is at stake, given to your point that NVIDIA has led the way up out of the April nadir. Charlie, thank you so much. Charlie Wells there, setting us up for tomorrow, the big event, NVIDIA earnings. Speaking of which, coming up, we're going to set you up for your trading day. We do have some data and some Fed speak on deck. We'll go through that next on your Bloomberg Brief. Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Tuesday. Hopefully you've had your rest from your long weekend, because we are going to kick off this short week with some data. Durable good orders, those come at 8:30 a.m. Eastern. Then we'll have Conference Board consumer confidence at 10 a.m. We'll be continuing to see the divergence between the hard and the soft data. We'll also get some Fed speak. New York Fed President John Williams will be speaking at 8 p.m. from Tokyo. Before that, though, do not miss this, our interview with Richmond Fed President Tom Barkin. That comes at 9:30 a.m. on Open Interest. The Fed speak we've been hearing has been much the same. Stay put, don't react, as we wait to see how tariffs shake out. Now, some micro movers to keep track of this morning. Some stocks on the move. U.S. Steel falling this morning is down 0.5%, but that comes off the back of a 21% gain on Friday. President Trump had announced a partnership between U.S. Steel and Nippon Steel out of Japan, something that had been back and forth with both Trump and Biden previously, not wanting that deal to take place. Trump media, you can see here, up nearly 11%, planning to raise $3 billion to buy cryptocurrencies. That's the latest reporting from the FT. Finally, Salesforce looking to buy Informatica again. Those shares up 10.7%. Acquiring the software company. Those talks ongoing. A quick check on your global bond market this morning, because it is a rally that has been ignited by Japan. Reporting suggests that the Ministry of Finance has been out there doing surveys of market participants and is considering pulling back some of its issuance. It was this time last week that you had a 20-year Japanese bond auction that went really poorly, meant yields globally went higher. More issuance is a story throughout the globe, especially in the U.S. as the budget makes its way through D.C. Regardless, we're looking at a global bond market rally because of that. Your 10-year yield lower by just about 5 basis points. In Germany, lower by 2 basis points. All right, that's it for your Bloomberg Brief. Surveillance will take things from here.